Oh no, the sky is falling. We gotta get out right now, right now. Or wait, is it? Um, well, that's a bit more debatable. This really had to happen. If you look at the 5 year, just this ballistic, it wasn't gonna keep doing this forever, obviously. So we have to have some correction to the general norm. So nothing to really see here yet except what you definitely would have expected if you have been following me in the past or following anyone else. We just got to get back to a more general norm than this skyrocketing difference can't go on forever. So let's see what caused it to top out at this moment. Are we heading down more in the future? Let's talk about that. Few things to explain how this happened and why it was so dramatic. We have retail investors have been going crazy lately. We have 43% of retail investors are using leverage right now. In particular, if you look at chart of retail investors that pay with options, you see this around 2018 is when Robinhood started allowing options to happen for free and to all its users. And around here is when we started seeing other brokerages start to allow that. So you can see right now it is currently skyrocketed something ballistic. Now, what does that cause on the market? Usually you would think that a bunch of retail investors can't broadly affect the market, but it's not what the retail investors do that matters. It's what the bigger banks and the brokerages have to do to cover their positions. So if we look over, just scroll down this article a little bit, and dealers hedge their exposure from selling calls by buying the underlying stock. This creates feedback loop as heavy call forces banks to buy the underlying stock, especially if the stock starts moving towards the strike price. Basically, what this is saying is that as the stock is moving up towards the stock price, the banks are holding the other end of the bet. Everyone buying in to saying that the stock price is going to continue to go up forever, the bank has to hold the opposite side of that trade, meaning they have to hold that stock in case the bet either is right or wrong. They need to hedge their bets. They don't really care how much money they gain or lose as long as they always controlling risk. As long as they always are making money and controlling their risk, they don't need to win every bet. They just need to ensure they don't lose very many bets. So they're hedging their risk, and this is what is causing the underlying stock price to be bought continuously, and this can cause a spike up on a retail doesn't have the ability to move the market by themselves, but by buying call options, they force dealers to hedge themselves and triggers this problematic move in tech stocks. So, and at the end of this, it mentions how this happens until it stops happening, until the music stops playing. It's kind of like musical chairs. Everyone's going to go up and party together because the more call options someone buys, the more the banks have to feedback loop, have to cover their positions until when? Until the punch bowl gets taken away by the banks. The banks start deciding that they're going to turn it the other directions. Banks instead ditch their hedges, exaggerating the sell-off. See this on a broader scale. If you just want to compare the people that are trading in small amounts, 10 contracts or less, each contract controls up to 100 shares. So these are people that are controlling less than 1,000 shares. So that would be me, that would be you. But institutionals, 1,000 shares is not actually that much. So every institutional buyer is going to be this pink line. So if you just look at the divergence coming up here, most of the option trading, even though like you would need 5 of these just to equal 1 of these, even with that, and this is all based on volume, so it does take 5 of these to equal 1 of these. And even when you consider all that, you still see that the most of the option trading going on right now is significantly retail. It's significantly small investors. The big investors are either not trading as much in options, or more likely they're just trading as they normally do, and retail is spiking. So what does it mean when a lot of first-time retail investors, for the first time using leverage, they've never used it before? If you just take a look, and we already looked at this chart, but you see how much it's skyrocketed recently for the small traders. They didn't exist before this, but now everyone's trading on Robinhood. Everyone's grabbing these new apps and throwing in all their money for the first time. What does this mean for happening after that? Well, I can tell you what. Then all of this has been happening in tech stocks. If you look on Robinhood, a lot of the tech stocks are very exciting, especially for the retail investors. They are gobbling up, placing all sorts of call options on that. The Nasdaq has led this charge, but that is Nasdaq right here. As you can see, recently it's being shorted. This is the marketing the shorts. Short futures are up a crazy percentage. But importantly, that's just to give you some perspective, that is the highest since '08. So no one has been shorting Nasdaq tech stocks. No, there has not been this many shorts on tech stocks since 2008. While at the same time, we just had the most retail investors in history going bullish on tech stocks. What does that mean? Well, it means the most obvious thing that normally happens. The average retail investor using options or margin or investing in general doesn't make as much money as the big ones. They're going to lose this bet. This is the month wealth transfer happening right in front of your eyes. You have the spike up because the retail investors were buying those call options that forced the banks to cover their bets. They had to buy the underlying stock. So you got this skyrocketing amount, but it's not supported by the overall trend. The overall trend would have it come somewhere at this angle. Or if you look at the other S&Ps, it would be somewhere in this angle. You cannot continue up to this forever. So all this short-term call options, it all has to be ended at some point. And interestingly enough, when did it end? That's also very fascinating. If you just look at the S&P 500, interesting, when was that ending? It peaked at, oh, look at that. That's it's hard to put it on there, but what you can, the date specifically, it's September 2nd. What happened September 2nd? Well, funny enough, that's when people had to go back to school. In particular, a whole bunch of retail, young Robinhood investors all had to go back to school. And so many of these contracts lately have been short, 24-hour or a week long. You can very easily, just with like one or two clicks on Robinhood, you can options trade. So people who have no experience in it can, in theory, and did for several months. So they got lots of confidence in this area where they were able to, in a 24-hour period, bet the market's going to go up, and in most cases they would win. So they made some money, they lost some money, but in large they raised their confidence. They got more and more confident throughout here. But that's all ending now. They had to go back to school, and the market's not necessarily predictively going in one direction anymore. So we're going to see a lot of pain, even though there was a lot of hype coming back into this. But as you just see, no matter how you want to calculate this, even though I have a belief that the market's going to go down in general, that's a side question. No matter where your belief is, it's just that this was ballistically high. It could not continue forever, and back to the trend, the 200-day moving average is somewhere down here. You have the 100-day moving average, it's somewhere around here. It's a little closer to that. We'll see if it supports on those, or if you see another tracing of a new bottom as we move forward. Either way, though, we just have to get back to some lower levels to make this all make sense, and that's why the banks have decided to turn the tides on that call of speculative rally. The real question is that will this continue to market down the market, or will it just bounce off of one of its moving averages and continue to go up? Well, let's talk about that. We do have several factors that come into play, like all the election turmoil. Just one quick thing to mention, this came in all over the news lately. You got global banks reporting $2 trillion and suspicious transaction over 2 decades. Wow! Crazy, $2 trillion, big number, over 2 decades. What that ignores and doesn't mention, however, is that dating from 1999 to 2017. So the newest, the most recent thing that this is even talking about was actually 3 years ago. Even though this is all over the news the past few days, they're pumping this like crazy. It's actually old news. So Why? And it talks about it here somewhere that this was actually a leak that happened. So why is it that 3-year-old news over 2 decades worth of information, so really, really old news, why is that coming out with a big, scary number right now? Well, the reason it's being pumped all over the news is simply this. These people right here that own all these shorts in the market, they probably also own the news. Very, very simple. This could have come out last month. There's no reason for it to come out last month. In fact, it was, when you go to the news channels, like, they don't just have, oh, this is the story of the day, we have to print it. No, no, no. They have hundreds of stories all over their desk that come up all the time, and some of them have been on their desk for months. This story could have been on their desk for months. When do they print it? Or even if it just did arrive on their desk on that particular day, do they push it a little? Do they push it a lot? Which page is it on? When what would be old news is just randomly leaked and then pushed heavily by the media at a particular time with big scary numbers and scary headlines, it's because somebody is shorting the market and they own the media at the same time, so it's all working together. Now, does this mean we're moving down to a 200-day moving average or going down all the way? We don't know that, but this is all part of a play to bring it down at least a little bit. We'll see how far. Now, what are some of the other things to be worried about? Well, one of the things to be worried about is that we got stimulus gridlock. If you've been following my channel, either my TikTok or the YouTube channel here, you would have known that we've talked about how there's not that many incentives for anyone to pass anything before the election. Nancy Pelosi would appear weak if she made a deal with Trump, and Trump would appear very strong. He would be getting done and helping people through this terrible time. A lot of people, it's the last stimulus checks were so long ago, but mainly they're just out. So if someone is talking about the election and how much good they've done for the country, the last stimulus is old memory, and it's going to be hard for Trump to make the argument that he has saved you if you are currently getting foreclosed on, if you are currently unable to pay rent, if you are currently out of job. It's going to be very, very hard for him to make the statement that he is making it better for you and that he's getting us out of this crisis. While on the flip side of things, if he is able to break this gridlock and make a stimulus bill pass right before the election, we're not that far away. We're really not. So if he's able to do that, it will still be in everyone's mind when they vote. So that would be extremely bullish for Trump if there was able to be any kind of deal. It wouldn't matter what the stimulus deal is. Any kind of stimulus deal would be extremely bullish for Trump, which is why I don't think it's going to happen. Nancy Pelosi will not let it happen, is the short of it. And that's not a political statement. That is a tactical positioning statement. And that's just the way it is. Everyone's playing tactically. It's not actually to make you unhomeless. Is not actually to make you have a better job. The government's not there to actually serve you. No, they have their own set of incentives, which is simply that they need to get reelected. So they will follow those incentives, and they will not want the other side to appear strong. Now that could in theory change if they are forced to move, if things got extremely bad enough, but we are so close that I think more that we'll just get into that panic. A lot of scary things will get really, really close to happen, but we're just so close to that election that it would be really, really hard. Because you need like a month worth of pressure. So if things get really, really bad, it's not going to matter on the first few days. It's going to matter after a month of things being really, really bad. I think they'll just hold out, but we'll have to see. Either way, the biggest problem is that there is uncertainty around whether or not there's going to be stimulus before or after the election, what the stimulus would look like, and there's also so much uncertainty about whether or not Biden wins. And this is also not a political statement. I'm not gonna go into who I'm for, but there's just a simple fact that if Trump wins, you get a continuation of relatively the status quo. If Biden comes in, relatively change. If you don't know who's going to come in, then you are uncertain. Either way, this pressure of uncertainty is going to build up until the election. And there's a lot of factors that work into that. Just a few things that would happen if Biden did win. 15%, $15 minimum wage sounds great. Universal pre-K. Mixed feelings on that. Higher capital gains tax. Oh, and everyone thinks that this is so progressive to do this higher capital gains tax. And I would agree with them if there was some stipulations on it, which there are never are. They really ignore that. Higher capital gains tax is also really terrible for you and I, these really, really small investors just getting in to the market. So if we take a look over at my portfolio for just a second, you see that I only got $6,000. I got about this much more in other locations. So I got about $12,000 in stock and probably another $6,000 cash. This plus some more cash in other places. But either way, my point being is that anyone my size or anyone smaller than me, they are also going to be hurt by this capital gains tax. So it's a little bit ridiculous for that they saying that it's progressive when someone, even if you just have $200 to invest, this higher capital gains tax is going to screw you, which really I don't think it's that progressive to hurt someone who has only $200 to invest in the first place. So this really, really hurts small investors just as much as big investors. In fact, I would say it hurts big investors even less than it hurts small investors. And that's because big investors are usually not getting into a position unless they already have their exit planned, and their exit being a way that they pay less taxes in general. No one with a whole lot of expertise and a whole lot of money is going to put themselves into a position where in the near future they're going to have to pay a shit ton of taxes. A retail investor, on the other hand, doesn't have enough experience to forwardly think and avoid those scenarios. So this will hurt retail investors actually more than it will hurt big-time investors. And that's why I do not think higher capital gains taxes is actually progressive unless you want to put an income cap on it. Like say, we're going to only tax capital gains tax above $100,000 of gains. That would make it so small investors would be able to get tax-free capital gains, and larger investors would be taxed for their gains. I think that would be extremely progressive, and that would be extremely exciting, but no one talks about that because they're not actually looking to help out the small investors. They will put that market spin on it, but they're not here to help small-time investors. Let's continue to talk about that, and there's the next thing that she wants to do. Financial transaction tax of 0.2%. Now, they tout this. The spin on this, they tell all the people how this is going to be that small investors won't even notice this 0.2% tax. It only comes to $6 on $3,000, or something more reasonable for a small-time investor. You're saying you do $1,000, that would only be $2. So a $2 on $1,000, you're right, that doesn't seem like much at all. But again, I refer you to the big advantages and disadvantages of a small-time investor versus a big-time investor. A big-time investor is not going to be making this is a financial transaction. So you potentially lose money whenever you make a transaction. An experienced, big, knowledgeable investor is not going to make a financial transaction unless it is advantageous for them to do so. Therefore, a 0.2% tax is going to be worth it to them. They will still be able to make money because they will only do a financial transaction in the first place if it is advantageous to them. On the flip side of that, retail investors do financial transactions all the time, regardless of whether or not they are actually beneficial to them or not. They may, for instance, sell their overpriced stock to then buy another overpriced stock, which means all they've actually done is now have to pay a higher capital gains tax, and they have to pay this transaction tax, and they didn't actually make any money. Whereas an experienced investor would likely have avoided some of that capital gains tax, and they're making that financial transaction because they know it's going to be better for them in the future, and that little cost won't matter. Whereas the retail investor, it will just eat away at your gains over and over and over again, what little gains you are lucky enough to have, because you're not getting them based on skill. They're just going to get eaten away because you're going to be making pointless trades that you shouldn't make. One of the things I've noticed as I've invested more and more and more is that the more long-term my thinking and the less often I just buy and sell things in a frenzy, the more money I make overall. And that's just basically you making your decisions more calculatively. You do make decisions, but maybe not make a decision every time you get an impulse to. Do it every fifth time you get an impulse and make sure that you're very confident. Retail investors are going off their impulses. If you're making financial transactions on your impulse, this tax will hurt you. If you only make financial transactions off of well-educated times, then yes, this won't affect you. So this is going to affect small investors. It's not going to affect big investors. It's not good for small investors. Affordable housing, another thing she's going to do. Affordable housing is one of the terms I hate. It's a spin term. It doesn't mean what you think it means. Here's what actually happens when someone develops affordable housing. So you have a crappy, shitty place that's gone down in value. The whole neighborhood, every place has gone down in value. It's poor there, and a lot of people that can't afford the rent. So this is one of the problem areas that people look at, and they say, oh, okay, what can we do? Let's fund some affordable housing. Now, what actually happens when that happens is that what they first do is they buy one of the crappiest buildings on the block. One of the most depressed buildings on the block, and they fix it up real nice. The first result of that is that rents go up in the entire neighborhood. If you buy the worst house on the block and then you fix it up real nice, you actually raise the housing values of all the houses around that, which doesn't lower rents in the area. It raises rents in the area. So why is it called affordable housing if the first thing they do is they buy out the slumlord? Now, I know slumlord is a bad connotative term and no one likes a slumlord, but let's be perfectly honest, that's where I lived for the past 5 years because it was the cheapest rent in Seattle. I paid $645. That was my most recent rent. It was even lower when I moved into that place 5 years ago. I think it was like $450. But the point is that place would be a place that would normally be bought out by, it would be Bodo's actually, and rebuilt into a new building because it was a crappy house that shouldn't have had that many bedrooms, and the water was broken, and like the walls moved when you pushed on them because they weren't attached to the floor, and the hot water in the kitchen didn't work for like 4 years. But it was a really crappy place, and a lot of people would be saying that, oh, these renters are getting taken advantage of, so we need to buy out this building, Bodo's it, rebuild a fancy building in its place. Well, that then means that option isn't going to be there. That was the only place I could afford. This is the whole reason I have this stock portfolio, is because I lived in that place for 5 years and I was able to put money on the side. Conversely to that, after the fact, when that place is no longer available and they rebuild it with a affordable housing unit, rents are going to be higher in the entire area around it, which is going to be great for the landlords, but not good for the renters. It doesn't create more affordable housing for me. It means I have less options that are, let's say my maximum rent I can pay is $700. There are just less options under $700 if they remove one and make it real nice. The other thing that happens is that once it's an affordable housing building, they have all these qualifications to where I can't rent there because I supposedly make too much money. But I really don't make crap for money. That's just, so many people have been in that scenario where they don't really make much for money at all, but affordable housing says they make too much. So they can't, so I wouldn't be able to live there anyway. So it doesn't make housing for more affordable for me anyways. Or on the flip side of things, if I did qualify because I didn't make enough money, well, then the rents are too high that I still can't afford the place, because in order to qualify, you by definition can't afford it because their rents are still too high for anyone that qualifies for that really low amount. And on the flip side of that, once you're in, what are you going to do then? I mean, if you got a better job and more money, and shouldn't the government encourage you to get a better job and more money? Well, if you do that, then you're going to be homeless, because rents around the entire neighborhood have gone up. They bought out the crappiest building and rebuilt it and made it nice. Now rents went up around the entire area because they did this to there were 10 crappy houses, and they bought them all up, and they made them all real nice, and the 10 other medium ones that were in the area that did have decent prices as well, they comparatively can raise their prices now too, because their competition raised their prices. There's not any crappy places in the market taking that bottom price anymore. There's no slumlords. Again, everyone thinks slumlord is a bad term. Well, it can be, but it's also the only place you get cheap places. There may have been some health code violations at where I was living, because like the hot water in the kitchen not being fixed. But good luck finding a place in Seattle under $650. I was 4 blocks from one of the main downtown transit centers. I could walk to work. I could walk home from the downtown area. I could walk home drunk from the bars. Good luck finding anywhere in the city of Seattle that's around $645 a month with all utilities included. That's what the power of crappy, broken down buildings offers you. And if they buy all those up and make them into quote unquote affordable housing, well, guess what? There won't be anything left of affordable housing. So a lot of these things are not really going to be good for they're all couched in things that are good for the less income people, but they're not necessarily good for that. Or at least it doesn't help you go in a good direction. It more like traps you where you're at. Another thing they're going to get rid of is eliminating the like-kind exchange. This would be a really good thing, and it depends. One of the problems with this is that, again, there's no exceptions. So they tout it as if they eliminate the like-kind exchange, this is going to put a real tax on all the millionaires out there, and it's not going to tax you and I. But the problem is that if you only have one house, or like it's if you're trying to build wealth from nothing, this really, really hurts you, because it ruins your ability to get a fixer-upper home, fix it up, and then house hack it, do all the tricks you have to do to eventually then sell it and get another house. You do a like-kind exchange. And yes, that is how people build money, and you want to tax the rich rather than the poor. I totally get that, but how am I supposed to get rich in the first place if I can't even do this once, if I can't even do this to my primary home? All I'm saying is that they're probably, if in order for this to really meet as much as they told it to be this big benefit for the poor, this big tax on the rich, we're going to get those rich people and tax them. Well, then why are there no exceptions? And you may want to realize that the way they talk about a thing is usually the spin on it. It doesn't mean it's actually going to have that effect. You have to critically think about what the effect is going to be, and not base your argument off of the way they spin the argument. The way they spin the argument is always going to make it look good. It's not necessarily going to be the true effect of it. And the true effect of eliminating the like-kind exchange will be mostly bad for those people that are just going from that only have one house. If you have 10 different houses and you're trying to do a like-kind exchange, well, yes, this would tax you, and that would be bad for that person with 10 houses. And no, I feel no pity for them. But that's my point, is that they're not feeling any pity or problems either. If you got 10 houses and you want to switch one of them to a different house, and you have to pay a little taxes on that, you're wealthy enough that you can handle that, and it's not really an issue. On the flip side, and in fact, my point is that you'll continue to make money year in, year in, whether or not you have a like-kind exchange or not. That will just factor into how much you charge rents, and therefore rents are actually going to go up. And the person with renting 10 houses out, they are not going to lose money from this. Who will lose money from this? The person who just has one house, the person who had to work their ass off, like I plan to do when the housing market crashes eventually. I plan to buy a house, and I plan to hack the shit out of it as much as I can. It's gonna be really hard, because I'm building wealth from practically nothing. I'm one of those millennials. It's very hard to break into the housing market. Most millennials haven't, unless they have a really high-end job. So this is a ladder. What the people don't realize is that, yes, this will tax the rich, But it will also take the ladder away so that no one can become rich, because now you can't move from a crappy house into a medium house into a better house into an amazing house. You aren't able to build that wealth that way without being taxed all along the way. Again, someone who has 10 rental properties, this won't matter because this will just aggregately raise rents across all their properties, and it won't matter their bottom line at all. They'll actually just have more cash faster, so it will actually help them. It will create disadvantage for those that just have one house and they're just looking to build wealth for their future. Those that are going to possibly be millionaires in the future but aren't millionaires yet. This hurts future millionaires, helps current ones. Again, the government may say they're trying to help you, but you have to look at the actual effects of their policies, and usually, no, the actual effects of this are not good. And to anyone who says otherwise, then why isn't there a situational exception made? Why not for someone's first house or funds up to $1 million? Let's say let's eliminate the like-change exchange for up to $1 million, but then or I mean let's keep it there for under $1 million, but let's eliminate for over $1 million. That would properly tax the rich and allow people to still get rich. Those who are poor, it will allow them to at least attempt to get rich. This takes the ladder, so it doesn't allow poor people to get rich in the first place. And we need poor people to get rich in the first place so that we can tax them when they get rich. So all I'm really saying is this is just going to create a lot of uncertainty beforehand. No one's going to really know what's going to happen until election. So I do foresee that we're going to get some increased volatility right up until election. If you just look at how long this took, we got from March to September. So if you just look at how long it takes to go up, there's a famous saying that stocks take the stairs up, but they take the escalator down. So if you just took how long it took from March to September to go up here. That's like 6-7 months, I don't know, something like that. So it took quite a few amount of months. We don't have that much amount of time before the election. We do have this took from February to March. So that took 1 month, 1.5 months. Well, look, that's about the time we have. We do have time for a crash, but we don't have time for it to go back up again after that. At least not until after the election. So if it's gonna go down to a 200-day moving average or retesting a bottom and even lower, something down here, 100-day moving average and 200-day moving average, those are all up here. But if we were to retest a new bottom, that would be somewhere around here. If any of those things happen, it's just going to take many, many months for it to go back up again, even in all the wishful thinking you might want to imagine. That wouldn't happen until after the election because it takes too many months. We only have a couple months to go. Literally 2? 1.5? Not enough time. We don't have the time for, if it does crash like here, either to something here or something here, it's going to take way too many months for it to get back up. And there's going to be all that uncertainty in the market. There's going to be no reason for it to go up this fast. This was too fast. And it's going to at least take this long. So I think we're going down, and I'm not a financial advisor. Get your own advice, do your own research, blah, 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 blah. This is for entertainment purposes only. But I just think the timing is that we're running out of time, and that we do have time to retest a new low. But if any new highs were going to be happening, they would need to happen after the election when there is less uncertainty in the market. The market hates uncertainty even more than it hates bad news. Bad news, it can plan for. Uncertainty, it just gets scared, and you have money on the side that doesn't invest. If you have bad news, then you can invest knowing that bad thing is going to happen, and you can invest to take advantage of it. So investment can continue in the presence of bad news. In the presence of uncertainty, though, money stays on the side, and that is what we are experiencing now. And this uncertainty goes in both directions. We have the Ruth Bader Ginsburg. She died. They're gonna have to replace her. Trump's probably gonna get that nomination. He has the Senate. There's no reason for him not to be able to get a confirmation before the election. So there is That's a conservative direction things could go, and there's the possibility that Biden could win, so that's a liberal direction things can go. And so you have just polar opposite directions of where the economy could go next. And if businesses knew which direction it was going to go, then it wouldn't matter if the news was good or bad because they could make money off it either way. You and I might lose out and might be bad, but the big companies and the big corporations and those with a lot of money, those high net worth earners, they're going to do fine either way if they have some certainty. Without certainty, everyone's doing bad, even the rich. So in closing, I just want to remind everyone of some of the Fed's comments. They talked about inflation possibly beginning in the year 2023. Notice thing they mentioned there is that it's going to begin in the year 2023. They're not really expecting inflation to start until then. Inflation will probably be, and even if it does happen, then it will take a while before that inflation really matters, before, let's say, it makes up for the deflation currently happen. What they did not say, but what that you can take from that, is that, well, if inflation is not going to happen for another 2 or 3 years, then what's the opposite of that? That would be the current situation, and that is deflation. I do believe we are going to a deflationary time. We have not yet seen the crash like what we had here or like we had here. That has not happened yet. We are still very early stages into all these bumps before, and that is the stage we are in. We are getting all this panic, this volatility, this fear, this uncertainty, but we have not yet seen the crash, but we have seen the unemployment. The unemployment has happened, and that is going to affect the market. I am still not working. There's a lot of other people not working right now. You see the unemployment rate. I'm still counted as unemployed. I have not worked since February, but the unemployment rate says I am. The numbers are screwed. No one is working. This economy is going to into a recession, and the market does not reflect that yet. So just something to be aware of. Eventually, the market will have to reflect the recession that we are in, and there is so much chaos coming up right before the election, and it takes many months for the market to go up. It only takes a single month for the market to go down. Do what you like, but I am removing risk at this time. I am mostly in cash. I have a short on the market, but that is my own opinion. Follow me below, follow me on TikTok, but most importantly, do your own research, and I am not a financial advisor. Good luck to us all.